Okay, so what in the world just happened in the gold and silver markets? It was like a financial tsunami came out of nowhere and just wiped out trillions, leaving pretty much everyone completely stunned. But here's the thing. Was this just a normal market crash? Or is there a secret game being played behind the scenes that nobody on the news is talking about? Well, we're about to pull back the curtain and find out.
I mean, just get a load of this number. In a single day, one day, the price of silver dropped by 27%. Let that sink in for a second. If you had $100 worth of silver when you woke up, it was worth just $73 by the afternoon. This wasn't a little dip, folks. This was an absolute free fall.
So this brings us right to the big question we're digging into today. What really happened here? Was this just the market doing its thing, a natural correction? Or was this a deliberate move, a hidden game designed to tank the price on purpose?
All right, first up, let's go over the official story. This is the explanation you're going to hear on all the news channels. It's the simple, neat and tidy reason they're giving for this massive price drop.
So, the argument goes something like this. Gold and the US dollar are kind of like two ends of a seesaw. When the dollar goes up, gold usually goes down. And right now, the economic data looks good, which means the Federal Reserve is probably going to keep interest rates high. Now put yourself in a big investor's shoes for a moment. Why would you hold gold, which pays you zero interest, when you could just hold dollars in a bank and get a really nice return? It's a pretty logical technical explanation, right?
But, and this is a big but, that's just the story they show you on TV. It's the surface level stuff. The real game, the move that actually caused this whole crash, is happening completely behind the scenes, hidden from plain view.
And this, my friends, is where it gets really interesting. We're about to pull back that curtain, and I'm going to show you the hidden force that was used to intentionally bring this market to its knees. To really get this, let's use a super simple analogy. Imagine you're renting a house for, say, $25,000. You can afford it, it's fine. Then all of a sudden, your landlord shows up and says, hey, starting tomorrow, your rent is $50,000. You freak out, you scramble, but somehow you make it work. But then just 2 days later, he comes back and says, yeah, it's $75,000 now. What can you possibly do? You have no choice, you're forced out, you have to pack up and leave.
Well, that rent I was just talking about, in the financial world, that's called a margin requirement. It's basically the security deposit a trader has to put down to make a trade. And the Chicago Mercantile Exchange, the landlord in our story, well, they hiked this rent 4 different times in just 6 weeks. This forced traders, especially anyone using borrowed money, to sell everything they had, immediately, just to cover the insane new costs.
So think about what happens next. When thousands and thousands of traders are forced to sell all at the same time, not because they want to, but because the rules suddenly changed on them, what happens to the price? It completely collapses. So I have to ask you, does that sound like a natural free market to you? Or does that sound a lot more like manipulation?
Now, if you're sitting there thinking, wow, that's a shocking one-time event, I've got some news for you. This isn't a new trick, not at all. It's actually a very old trick, and it just keeps playing out over and over again.
You've probably heard that famous saying, history doesn't repeat itself, but it often rhymes. Well, when you look at the precious metals market, that rhythm is so loud it's impossible to ignore. The specific details might change a little, but the pattern, it's exactly the same.
I mean, just look at this pattern. Back in 1980, on a day we now call Silver Thursday, they used sudden rule changes to crush the Hunt brothers when they tried to corner the silver market. Then, let's fast forward to 2011. Silver was getting incredibly close to its all-time high of $50 an ounce. And what happened? Surprise, surprise! Margin requirements were hiked out of nowhere, and the price crashed. And today? It's like we're watching a rerun. It is déjà vu all over again.
But hold on, because the story gets even weirder. There's this massive, strange disconnect between the price you see on a computer screen and what's actually happening in the real world with physical gold and silver. On one hand, you've got the paper market. This is the price of digital contracts and futures, and that's the price that we saw crash. But then, on the other hand, in the physical market where people are buying actual coins and bars, demand is just through the roof. The US Mint is reporting shortages. In China, people are literally lining up around the block to buy gold. Demand in India is soaring. So while the paper price is falling, the demand for the real physical metal is exploding. And for silver, specifically, man, this whole situation is like a coiled spring. Think about it.
Our entire modern world runs on silver. It's in electric cars, it's in our smartphones, and it is absolutely essential for solar panels. Industrial demand is just exploding, way beyond what's being mined, and yet the paper price is being artificially pushed down. The more you press down on that spring, the more powerful it's going to be when it finally snaps back.
Okay, so we've broken down the problem, we see what's going on, but what does this actually mean for you? How can a savvy investor take this environment of fear and turn it into a potential win?
You know, there's a classic piece of investment advice that says the best time to buy is when there is blood in the streets. In other words, when everyone else is panicking and selling for their lives. This price drop wasn't based on fundamentals. It was manufactured. So for someone who understands what's happening, this isn't a disaster. It's a discount.
So, what's a smart strategy in a situation like this? Well, number one is simple. Don't panic. Understand this is a game being played in the paper market. It's not a sign that gold's real value has collapsed. Number two, and this is absolutely critical, avoid leverage. Don't trade with borrowed money. Why? Because the market makers can and will use these same margin hikes to wipe you out. And finally, a lot of investors use a technique called dollar cost averaging. Instead of trying to time the bottom and throwing all their money in at once, they invest a fixed amount regularly. It averages out their purchase price and dramatically reduces the risk. And hey, if you need any more conviction, just zoom out with me for a second and look at the bigger picture. Look at what countries are doing. Nations like China and Russia are quietly stacking up tons and tons of physical gold. The BRICS nations are openly talking about creating a new currency backed by gold. It's all part of this huge global shift away from the dollar, a trend called de-dollarization. So while some big banks are telling you gold is a bad investment, the most powerful countries in the world are buying it up like crazy. In the long run, real assets always win. So when you put it all together, the conclusion is pretty clear. What we just saw, this isn't a crisis for gold and silver. Not at all. The news will try to scare you, the market will try to shake you out. But for the investor who understands the real game being played, this isn't a crisis, it's a golden opportunity. Which really just leaves us with one final big question to chew on. With all these forces swirling around, the paper market games, the insane demand for physical metal, and these massive global shifts, is gold finally going to break through and hit a new all-time record high next year? I'll let you think about that one.